All right, gold is near its record highs. AI stock is near its record hype. Now, one glitter with atoms and the other with algorithms. Now, both of them are powered by the same invisible force, liquidity and belief. When investors seek safety, they buy into gold. When they want to look for growth, they would look into AI. Now, here's the twist, right? Both these two assets can actually rise together, but both of them would also feed on confidence at the same time. Confidence that money would eventually hold a value or hopefully in the future multiply it. Now, we often talk about bubble bursting, right? Which is how everything could be a hype, everything could be a fad, and AI bubble has become this very, very popular term that everyone is talking about. But my theory now is, what if this is not a bubble? What if this one just doesn't pop? What if the AI bubble is better known as the AI balloon, slowly deflating as capital rotates, waiting for the next rush of air coming in from gold profits and hopefully shifting sentiments? Now, the current thing is that gold's strength at the moment right now says one thing loud and clear for everyone in the market, right? Fear is still in the air, okay? Fear hasn't left the room. Central banks are stacking it. We got Fort Knox having billions of dollars worth of gold, trillions of dollars worth of gold, right? And investors are hedging quietly. So if your next door neighbor is talking to you about buying gold, chances are you already know for a fact people are hoarding gold, which is why we're looking at gold reach the all-time high of about $4,300 per ounce. So, of course, with that safety bit that comes with a cost. When gold prices are high, the upside generally would shrink down. Now, gold does not compound, it doesn't innovate, it just sits in a vault or as a bracelet on you. Now, holding too much of it at high levels can also mean losing the opportunity cost, right? It means that you might be missing the next wave of growth. Now, once the fear premium starts to fade away, that parked capital goes searching again. Now, in this cycle, I think it isn't really heading into your real estates, your bonds, low interest rate funds. I think it's going to be drifting towards your risk on assets. It's going to be your equities, it's going to be your tech, AI, crypto. And just imagine this, right? The global market at the moment is just this single balloon. And gold is this air of caution, heavy, dense, and stable. And then AI at the top of it, right, is just this volatile and weightless air that's at the top of it. So when too much fear inflates on one side, the other side would compress. And when gold stabilizes at the top, I think that it would create room for more optimism to flow back in. Because it would make a lot of sense if when gold drops in price, it would also mean that fear is slowly walking out of the room. And when fear is walking out of the room, people would generally want to go towards the risk on assets. So, this is where my theory of how instead of calling it a bubble bursting, we get somewhat of a controlled deflation, a rotation of pressure, not this rupture of faith, right? So, of course, we have to look back on history. History gives us a lot of hints. After 2011 gold peak, risk appetite quietly crept back into equities, and you saw equities having one of the longest bull runs ever. The same pattern appeared again in 2020, when both gold and tech hits their all-time high. Now, the relationship is not going to be perfect, right? It's dynamic, almost conversational, but this almost shows you that gold and risk on assets can sometimes be a parallel hedge. Gold tends to say, I want to protect your value. So if you want to protect your value, buy gold. But the way AI would reply to that is, I want to project your value. I want to help you project all the money that you are investing into AI for a higher growth. Now, between them, capital continues to circulate and fear feeding into ambition and ambition recycling into fear. This is the circular theory that a lot of people are worried about. Now, holding gold still kind of makes sense, right? But I would think that it wouldn't make sense as an anchor, but more like a ballast, right? So too much weight in it during the peak pricing would means a lot of opportunity cost loss. So while the goal preserve your wealth, AI creates this illusion of endless upside, which is why you hear people talking about OpenAI, and all you're hearing about is this potential to be able to do this, the potential to do all this. The people who are arguing against the AI bubble, the people who are arguing with the AI bubble theory is saying that AI might not even be able to create that much value as compared to the amount of money, the amount of capital expenditure that a lot of companies are pouring into it right now. So clearly, AI might be creating this illusion of this endless upside. Now, of course, this illusion is fragile, right? But all these are still emotional to a certain extent. So this illusion might be fragile, but it's also fuel. So if gold continues to stay firm, it will cushion all the lending whatsoever, right? Investors don't have to panic sell all their AI stocks. They can effectively just re-enter into the AI industry gradually. And I think that's how a bubble becomes a balloon again. It's not going to be a bang out of nowhere, but a breath. So these are the things that I would want everyone to really look at. The three key signals, right? It's going to be a rising real yields, cooling gold ETF inflows, and broadening equity participation. Now, let's talk about these three things, right? A rising real yield would actually means that the Federal Reserve thinks that inflation is not doing really, really well, hence they need to increase rates. But let's be honest, the Federal Reserve is a little bit behind, so chances are rates are going to be going down instead. So that is not going to be a real concern. Now we have to talk about cooling gold ETF inflows and broadening equity participation. Now, gold ETF inflows, the moment we start to see a slowdown in your gold ETF inflows, it will just mean that people are not that worried anymore. People are not dollar cost averaging into such ETFs, which we would like to imagine that those money would slowly be flowing into riskier assets. And of course, broadening equity participation, that's just going to be just depending on how the people in the market, the investors in the market, just how much participation is going on. So of course, together, all three of them would mark the shift for the slow heartbeat of your capital rotation. So of course, when they align, you're not looking at this huge bubble bursting, right? You're going to be watching this rebalance of belief, okay? So gold may continue to glitter as it is, and AI can continue to stand in the spotlight and glow, but I think the real story is going to be how they are going to reflect each other, right? Fear and ambition trading places, hopefully 1 ounce at a time. So this is how I actually look at the gold and AI relationship. So hopefully, I hope that you guys found this useful. If it does help you in any way, shape or form, or even give you any sort of insight, please hit like and subscribe. You're watching Investing with Jeff, and remember, in the markets, the balloon never truly pops. It just makes some more room for more air. Thank you so much for watching, and I'll see you guys in the next one. Peace out. Bye.